You talk with CEOs all the time. You can understand why they might be nervous given what we just heard from President Biden saying we're going to pay for this by making sure the largest corporations pay their fair share. Are CEOs concerned about this?
Hey, first of all, thanks for having me back on. So what I would say is this. I think there is enough tailwind in the economy that we'll be able to do this comfortably. Let's have a little bit of historical perspective. Donald Trump cut taxes $2 trillion. If you look at the impact of that, also negligible. In fact, you go back to the second term of President Obama, compare that to the Trump 3.5 years before COVID. Fundamentally, under Obama, the market was up 9% more. Growth during both periods is around 2.5%. The point is, I just don't think it's going to have a meaningful impact. Also, let's keep in mind that during COVID, tremendous wealth has been created. The top 10% have created $10 trillion of wealth. I think the idea of a tax increase, particularly where half of it is corporate and only half is personal, is something we can handle. Now, of course, the key, very importantly, the key is that it is done for investment. And when we talk about infrastructure, be it physical or human, where the money gets applied, I think, is going to really be the most important question we have. And to the extent we really are focused on the physical side, water, airports, railroads, electric grid, that's a good thing. On the human side, to the extent it really goes to caregivers who can get back to work, to the extent it goes to education, therefore getting more skills for future employment, also a good thing. And we have a lot of, as I said, a lot of tailwind in the economy. Done right, this hopefully will keep that tailwind on a much more sustainable trajectory.
So Blair, I don't want to be too cute here, but I noticed a couple things you didn't mention in there. Things like Medicare for the elderly, for vision and dental help. Things like earned income tax credits and child tax credits. Because if you look at like the Penn-Wharton budget model, they say those things don't improve productivity. The things you mentioned, Blair, do. So do you draw a distinction? Do CEOs draw a distinction between investment in something that's going to increase growth?
I think we all draw a distinction. David, very fair question. We all draw a distinction. I think out of $4 trillion that we're talking about, you can, and again, that number will change, and we both know that. Let's assume that, at least what I've seen, 2/3 of it actually is investment oriented. If you look at the almost $6 trillion already spent, clearly when you get 6.5% growth last quarter, you can assume directly because of the tailwind that created. And I also, again, do think that given how well so many have done, the idea of shared prosperity makes sense, because really the goal here is to keep our economy growing on a sustainable basis. I think you're seeing last quarter potentially the peak of GDP growth. But if you can get to the end of 22, into 23 and beyond, and grow an economy 3.5% plus, that actually creates a lot of momentum for everybody.